Chapter 1, Accounting and Business. Pretty much this just is telling you giving you kind of an overview. And I know we talk about a lot of different concepts. I actually start pretty heavy with that. So that'll be pretty interesting. So the importance of accounting. So you identify what's happening in a business, and then you have to kind of back the laptop up. There we go. And then you record the actual transaction, and then you use accounting to communicate by preparing financial reports and different kind of statements. So accounting is an information and measurement system that identifies, records, and communicates an organization's business activities. And so again, identifying business activities requires that we select relevant transactions and events, because remember, there's some things that maybe aren't necessarily something that we have to record. We'll talk about that later. Recording is business activities require that we keep a chronological log of transactions and events measured in dollars. We do that through our journal entries, which then go into our ledgers and then go into our financial statements. And then communicating is business activities include preparing accounting reports such as financial statements that we analyze and interpret. So, and in this class, we'll talk a little bit about that. For sure, when you take 4B, you'll talk about that a lot more because it's managerial accounting, and then how using that then for managers to figure out how they can use that to make decisions. So record keeping or bookkeeping includes recording of transactions and events. And again, that's just one part of accounting we see. Now, there's different types of users of financial information. So remember that accounting is called the language of business because all organizations set up an accounting information system to communicate data to help people make better decisions. Accounting serves many users who can be divided into two groups, either internal or external users. And so, and I don't care if you have maybe a small mom and pop, or if you're a bank, or even at Merced College, we use accounting. We have to keep books, we have to understand what's going on. So external users, those are people like lenders, external auditors, shareholders, which are people that own stock or own ownership in a company, the board of directors, which are the people that oversee the company, regulators, and customers. Those are external users. External users have limited access to an organization's information, yet their business decisions depend on information that is reliable, relevant, and comparable. So for example, if you're thinking about maybe investing in stock, you would want to look at the financial reports of the company to find out if they're making money, if you'd want to make that investment or not. Or if you're doing business with them, figure that out. Or maybe you're a lender, loan officer at a bank, you're going to want to look and find out how is that company performing, okay? And in internal users, those are people that are directly involved in the actual business. So external users are not involved directly in the actual day-to-day running of the business. Internal users are the ones that are involved in running the business, such as the CEO and department managers and others within the organization. They use the information to help improve the efficiency and effectiveness of an organization. And then I hinted at this earlier, is that managerial accounting serves their decision-making needs. And we'll talk about, you'll learn about that in the next class, which is 4B. Okay, so people like research and development managers, purchasing managers, HR managers, marketing managers, production managers, distribution managers. Those are all people within the organization. They have to keep budgets, they have to keep things. HR, they have to know if they can hire people or are they going to have to fire people. Purchasing, do they have money to purchase this new equipment or purchase this supply, etc. Okay. Then we talk a little bit about the different types of people jobs that are available in accounting, which are a lot. And I noticed some of you mentioned you wanted to become CPAs and become accountants, but there's a lot of things besides that utilize accounting. So we see here in the financial industry, managers, taxation, and accounting related. Those are all different areas that use accounting information. And accounting information is in all aspects of our lives. When we earn money, pay taxes, invest savings, budget earnings, and plan for the future, we use accounting. So even us personally, we have to do that. You get your check and each month that you have to pay your mortgage or your rent. You have to make sure to save enough for food and for gas, for the car for the week or the month. We have to, pay taxes. We have to invest. All of those things on a personal side do, and it's very much the same way for the business and for the company. And again, the majority of opportunities are in private accounting, which are employees working for businesses. Public accounting offers the next largest number of opportunities, which involves services such as auditing and tax advice. Still, other opportunities exist in government and not-for-profit agencies, including business regulation and investment and investigation of law violations. So we see even in nonprofit organizations such as United Way or in a church or in any kind of organization, they still have to keep bookkeeping records as well. That's the same as a for-profit business would. And an accounting specialists are highly regarded. Their professional standing often is denoted by a certificate. Certificate public accountants or CPAs must meet education and experience requirements, pass an examination, and exhibit ethical character. Two other common certifications include a certificate in management accounting or a CMA, or a certified internal auditor or a CIA. So those are different things. Accountants are held in such regard, like when we have like award shows like the Oscars and some of those kind of programs on TV, it's the accountants, they have somebody that's an accountant that actually holds that and determines that so that information isn't released before they open the envelope and they announce it publicly. So it's very important. What I will say too, because I found out because of the class I was teaching out at the prison, is you can be a felon and still work in accounting, but again, and have a CPA, but again, it's going to depend on what exactly area you work in. So you have to, but you do want to make sure you have good moral character. So ethics, you'll find that that's an important thing. And that's a thing you'll find running through most of your business courses. You'll find out a lot about ethics. And if you go on and get your bachelor's degree, you'll take a whole class probably on business ethics. It's something that's very important, especially with some of the things that happened in the early 2000s with Enron, WorldCom, some of those kinds of things. Ethics is something that's important. So the goal of accounting is to provide useful information for making decisions. For information to be useful, it has to be trusted. This demands ethics in accounting. Ethics are, and this is important, ethics are beliefs that distinguish right from wrong. They are accepted standards of good and bad behavior. When we're faced with ethical concern, the first step is to recognize it as such. So that's what you want to do first. Find out, is it some kind of an ethical issue that's taking place? The next step then would be to analyze all of your options, and then finally you have to choose the best option after weighing all of the consequences of that decision. And so that's something, you're going to have ethical, moral things. I mean, we experience that every day in our life. If we're going to take something or we're going to do something or whatever. I mean, in business, it's a little bit different types of things that take place. One of the things that we talk about is the fraud triangle. And so 3 factors have to exist for a person to commit fraud: opportunity, pressure, and rationalization. And so this is why it's important. One of the things that you think about in business is you have to have a structure in place that has internal controls. So for example, the same person that writes the check is not the same person that signs it. Or the same person that's entering information in, for example, bills into the computer, is not the same person that's signing the check. And that's an issue that happens in every kind of an organization that you have. So for example, I used to work, when I was going to school, much like you are, I worked in an office that did received donations because we were a private university. So people sent money, for different things that the college was doing. Well, my boss, she couldn't open up the mail and add up the donations by herself. So she had to have someone else there with her. And so sometimes I would sit there with her, and then she'd have her little adding machine. She'd add up all the checks and money that she received, and then I would have to initial the tape, and she would initial the tape before she processed it, and then that went to be deposited. Because again, having internal controls, making sure that she's not going to take something and there's not a mismatch there. And then I'm sure when it got down to the finance office, someone else counted it as well and made sure. Dual custody, yes, it's important. You have to think about that. We had an issue, some of you might have read about it possibly in the newspaper. We had an issue at Merced College. We had somebody that worked, and he obviously no longer works for Merced College, obviously. He worked in the purchasing department at Merced College. And he had a janitorial business, or he made up that he had a janitorial business, and he submitted some false bills to the college that he'd done services on a building in Los Banos that we no longer owned at that time, because we had another building in Los Banos that we were at before we built the new building where we're at now. And so he got paid fraudulently for performing services that he never did. And that was because there was a breakdown in this. He had opportunity, he had some kind of financial pressure, gambling or credit cards or whatever he felt, drugs, whatever he felt he needed money for. And then he was able to rationalize it to say, you know what, it's okay. It's Merced College. They have money. It's not going to affect them. They have insurance. Why? It's not going to affect them. It's important to realize this and then make sure that you have good internal controls within your organization. So opportunity, the person has to be able to commit it with a low perceived risk of getting caught. So for example, for this guy, he thought he could go on the computer, he could put in false things. He thought he'd never get caught doing that. He had pressure or the incentive. The person must have pressure or the incentive to commit fraud, unpaid bills or addictions. I know there was a woman, and I wrote a paper about it actually for one of my MBA classes on this topic on ethics, that she stole a bunch of money from Central Valley Nut Processing. And she was managing this guy's all of the bills for this business. She didn't think she was going to get caught. She was doing something, I don't know what, but she was doing something with this money. And then you have to be able to rationalize it or have the attitude that a person justifies a fraud. They don't see that it's criminal. They think it doesn't hurt anybody. And you see that a lot, people think that it doesn't matter. The other thing too that happens a lot, and I don't know if any of you noticed this, but like what one thing has happened in Walmart the last...
They put more security cameras.
Okay, what else?
Locked up all the detergent.
They lock up everything, right? The reason for that is that people take stuff. People shoplift. They take their 5-finger discount. And I know, I was discussing this with my students out at the prison when we went over this topic. It happens a lot. I mean, people think, it doesn't matter. It's Walmart. They have money. Or the people that work there think it doesn't matter. It was funny. Me and my girlfriend, we went and did Christmas shopping, and I got new socks. And I remember I had to ask somebody to unlock the cabinet, and then they took them and they put them at the register. We had to get them at the register when we paid. I mean, I thought that was just the wildest thing ever. Like, wow. But that was around Christmas time, and I'm like, that was crazy. And it's important to realize that, and again, thinking about it. So it's important to recognize that all 3 factors of the fraud triangle must usually exist for a fraud to occur. Absence of one or more factors suggests fraud is unlikely. The key in stopping fraud is to focus on prevention. It is less expensive and more efficient to prevent fraud from happening than it is to try to detect the crime. By the time the fraud is discovered, that money's gone. Additionally, it is costly and time-consuming to investigate. So for example, the issue at Merced College with the guy in a purchasing, that was done because we had an audit come in. And then what happened with Central Valley Nut Processing was the owner finally woke up and finally started realizing, oh my gosh, my employees, their taxes aren't being paid, and the work insurance isn't being paid, and things aren't being paid. And that's when he started going in and started then investigating and found out there were all these wire transfers and all of these things happening. So, and that by that time it was too late. The money was already gone. So the Sarbanes-Oxley Act, or also SOX, Congress passed this to help stop financial abuse at companies that issue their stock to the public. And so again, SOX, it requires documentation and verification of internal controls and emphasizes effective internal controls. Managers must issue a report stating that internal controls are effective. Auditors verify the effectiveness of internal controls. Ignoring SOX can lead to penalties and criminal prosecution for executives. CEOs and CFOs who knowingly sign off on bogus accounting reports risk millions of dollars in fines and years in prison. And again, this happened because of Enron, WorldCom, some of those kinds of things. This act came out of that. And so you'll notice when you look at like any kind of annual reports, you'll notice that the CEOs or whoever, somebody has to sign it. And also the auditing firm has to sign it. You also have the Frank Dodd Wall Street Reform and Consumer Protection Act. That was passed by Congress, and again, there's two important pieces to that. So there's the clawback, which mandates recovery for excessive pay, and then whistleblower provision, where the SEC will pay whistleblowers 10 to 30% of sanctions that exceeding $1 million. So that's when somebody in an organization, they report that there's wrongdoing, that would be called a whistleblower, somebody that reports something about their company that they work for. They could actually get money for doing that. So generally acceptable accounting practices. You'll also see it right here, GAAP. You'll also see it written out that way. Now, financial accounting is governed by concepts and rules known as generally acceptable accounting practices, or GAAP. GAAP aims to make information relevant, reliable, and comparable. So this is standards that are set that every business in the United States has to keep. Now, in other countries, they've adopted similar things, and so it allows things to be comparable. Again, international standards, again, we know that the world is becoming more and more globally connected. There is increasing demand by external users for comparability in accounting reports. So you have the International Accounting Standards Board, and in the issues, International Financial Reporting Standards. And so they issue that, and again, in today's global economy, there's demand for users. So the FASB and the IASB are working to reduce the differences between the US GAAP and the IFRS. So trying to make things, again, that you can understand what's going on, even if you're looking at a business in another country. The objectives, they're making sure that the information is useful to investors, creditors, and others. Qualitative characteristics required that it's relevant, reliable, and comparable. Elements defines the specific items that are found on financial statements, and then recognition and measurement set the criteria for when an item must meet for it to be recognized as an element, and how to meet for that. So when you record certain types of information. Accounting principles and assumptions are of these two types. General principles are the basic assumptions, concepts, and guidelines for preparing financial statements. Specific principles are detailed rules used in reporting business transactions and events. And so the measurement principle, or the cost principle, this is something that is very important. And that states that accounting information is based on the actual cost. And the actual cost is considered objective. You know what something costs. So let's say that you buy a new truck for your business. You know what that cost was. And then the expense recognition principle and matching principle is when a company records its expenses incurred to generate the revenue reported. So you have to match the revenue along with the expense. revenue recognition principle, recognize revenue when goods or services are provided to customers. So we recognize it when we provide it to customers, which might possibly be at a different time than when we actually get paid. We'll discuss that later. And then the full disclosure principle, a company reports the details behind financial statements that would impact users' decisions in the notes of the financial statements. We have the accounting assumptions. So going concern assumption, we assume that the business is presumed to continue operating instead of being closed or sold. So most businesses, we know that they're going to want to be able to continue to operate. And then the business entity assumption is a business is accounted for separately than other business entities, including the owner. So that's important, that personal expenses are kept separate then from business expenses of the owner. That's something very important, and to not mix the two. So personal expenses, business expenses, that's something that's very important. The other thing too is a company might own multiple different types of businesses or multiple different businesses. So for example, there's a corporation called Yum Brands that owns a lot of different fast food joints. Well, it's important that they figure out exactly how much, I don't know, Dunkin' Donuts made versus maybe Taco Bell versus maybe Pizza Hut. If whatever different chains that they own, they have to keep everything separate. The monetary unit assumption, transactions and events are expressed in monetary or monetary units, and in making sure that's consistent. So for example, one thing that you might not know is there's a company, you've probably seen on TV, the duck, quack, quack, the Aflac duck. Believe it or not, the Aflac insurance company, you know that they're here in the United States and they provide employee benefits to a lot of employees here in the United States. They also, believe it or not, are really big in Japan. And so they have to think about that too, and they have to specify that. When they do their reports, is what's in US dollars and what's in yen. And then maybe they have to convert the yen then into US dollars, because obviously they bring that money back here to the United States. So you have to think about that. And so that's something, again, to be aware of as well. And then finally, the time period assumption is the life of a company can be divided into time periods, which are months and years. So usually you'll have reports, financial reports that are done monthly, some that might be done quarterly, some that might be done annually. And so just making sure that you know what period those transactions took place. And then we see here the different forms of businesses. And so this is important to realize. And so you have a sole proprietorship, a partnership, a corporation, or a limited liability company. And so a sole proprietorship, or simply a proprietorship, is a business owner that's owned by one person. The person is a separate entity for accounting purposes. However, the business is not separate legal entity from its owner. So for example, let's say somebody owns a cleaning business and they're only one person. They go to people's houses and they clean. One owner, and maybe they even do all the work. And they could have employees, but they're the owner of the business. That's it. The business is being done by them. And the one thing you notice here is that they have unlimited liability. The owner is personally liable for the proprietorship's debts. So let's say you own a cleaning business and maybe part of that business is maybe you needed to buy a van to use and the business bought a van. Well, you personally would be responsible for that if it was set up as a sole proprietorship. But you can't commingle your business money with your personal money, okay? And that gets a lot of people in trouble when they do that. Now, a partnership is a business that can be owned by two or more people called partners, which are jointly liable for tax and other obligations. Like a proprietorship, no special legal requirements must be met in starting a partnership. The only requirement is an agreement between partners to run the business together. The agreement can be either oral or written, best if it's in writing, and usually indicates how income and losses are to be shared. A partnership, like a proprietorship, is not separate legally from the owners. So you might have maybe you and a friend, or maybe you and your brother start a business. So you're partners in that business. Or I see here the picture of doctors. I know there's a guy on Facebook that I follow. He's one of my friends. He owns a business in Modesto doing plastic surgery. And so it probably isn't set up this way because of what it is, but it could be. Is him and his wife, they both work together in this practice. He does lip injections and certain things. She does the actual surgery. So the lip, breast augmentation and tummy tuck. So it could be set up as partners where both of them, they've decided they're going to work together in this. They're going to share in the responsibility of it. More than likely it's not. More than likely it's set up like what our next two would be. Because again, as a partnership, you still are legally responsible for what happens there and the liability of it. So you could have a corporation, also called a C corporation, but again, there are other types of corporations out there, or is a business that it's legally separate from the owner or owners, meaning it's responsible for its own acts and its own debts. A separate legal status means that a corporation can conduct business with the rights, duties, and responsibilities of a person. A corporation acts through its managers, who are its legal agents. Separate legal status also means that its owners, called shareholders or stockholders, are not legally liable for corporate acts and debts. So you'll see a lot of times, like Merced College, it would be a corporation. We're not owned by anybody, well, by the state, but we really aren't owned by anybody, but the managers involved, the president, all these people, they're not themselves legally responsible for what happens and the debts of the organization. A lot of churches are set up as corporations as well. So the pastor himself isn't personally responsible, but the other, but obviously if it couldn't meet its commitments, then it would have to close down or would have to do something to wind that down. Now, a limited liability company or an LLC, that could be one person setting up an LLC. It could be multiple people. And again, the members themselves of the LLC are not personally liable for the LLC's debts. This is a separate entity that has the same rights and responsibilities, similar to a corporation. But so, for example, with my doctors in Modesto, it could be that they have an LLC. So it's a little bit different, but they're called members instead of being called shareholders or stockholders, the owners. And then we have, again, accounting constraint. So cost benefit, only information with benefits of disclosure greater than their cost needs to be disclosed. And then materiality is only information that would influence the decisions of a reasonable person needs to be disclosed. And then conservatism or industry practices are sometimes included as accounting constraints too. This is where we're going to get right into pretty much the meat and potatoes of this. Okay, and hopefully everybody else that went off, hopefully they'll be able to just hop right back on. Okay, so the accounting equation. This is something that will be very important for you to understand, particularly when we start actually recording transactions and start journalizing all of that. This will become something that will be very important for you to know. So you can think about ale, right? Which, by the way, is not what I have today. I have iced tea, but ale, right? Assets equals liability plus equity. You also hear it, assets equals liability plus owner's equity. So one of the things about this, and I don't think they don't show it that way, but we're going to show you some examples, is thinking about, if you guys have seen like a scale, like the scale of justice, both sides have to balance, right? So that's the thing you have to think about in accounting, is both sides of the equation have to balance, okay? Kind of just like in algebra, and they're teaching you, you have something and you're trying to isolate the variable, and you have to, what you do on one side, you have to do on the other. It's very similar concept. Okay. So realizing that, and then you also will talk about next week about debits and credits. Okay. That'll be interesting. We'll talk about that. So again, thinking about this, and again, realizing that assets equals liability plus the equity, which is owner's equity, could be capital minus the owner and the withdrawals that the owner makes, called drawing, when he takes money out of the business, plus revenues minus the expenses. And remember that your revenues minus your expenses, that determines your net income. Net income also, another way to say, is profit. And we know that for a business, the goal of a business is to make a profit. Okay, so assets are the resources that a company owns and controls. These resources are expended to yield future benefits. Examples of assets would include cash, obviously, supplies, equipment, land, and maybe web servers for an online services company. And then it goes on, and I'll read that in just a second. But again, thinking about cash. So if we think about Merced College, assets would be the cash that it has, because we have to use that to pay bills, to buy supplies, to pay for utilities, etc. Supplies. So for example, if I was teaching this to you in class and I gave you a printed copy of the syllabus, the paper and the toner that was used to print that, that would be a supply, for example. Or right now, you know, they're worried about having supplies to clean the classrooms and disinfect the classrooms right now. These would be examples of supplies. Examples of equipment would be computers, photocopy machines, anything that would be examples of equipment. Things that they're not used up in the process. So desks, whiteboards, all those things would be equipment. Land, which is where the building sits, and then any other equipment. So the web servers, anything like that is an example. Now the term receivable now refers to an asset that promises a future inflow of resources. A company that provides a service or product on credit is said to have account receivables from the customer. So an example that I like to use, for example, is my dentist. He is great because he doesn't make us have to get care credit or anything like that. So he holds the balance. So let's say he does $100 worth of dental work on me. Well, I can promise to pay him. So he has an accounts receivable of $100. And then once, you know, if I have to make payments on that, then there's an inflow of cash, then reduces the account receivable, but then it increases the amount of cash that he has available. Okay. Liabilities now are a creditor's claims on assets. These claims reflect company obligations to provide assets, products, or services to others. The term payable refers to a liability that promises a future outflow of resources. Examples would be like wage payable to workers, accounts payable to suppliers, and notes payable to banks. So again, if you think about that, for example, at Merced College, if you think about the fact they may have wage payable, but they haven't paid it yet. So for example, for us as part-time faculty, they pay us on the 10th of the month. Well, today being the first day, obviously we're working, so that's creating a liability for them. They're going to have to pay that. And so usually they pay, and usually it's paid for the month that happened prior. So for example, my next check I'll get on September the 10th. Obviously there's going to be a time where they're not going to be able to they're not going to pay it out right away. They're going to wait until September the 10th to make that payment. And then with accounts payable to suppliers, you have to pay for suppliers, but you don't have to pay that cash right away. But you will, have to at a date certain. Same thing with a bank loan. If you take out a bank loan, you have to pay that again with specific terms. Now, equity. Equity is the owner's claim on assets and is equal to assets minus the liabilities. This is the reason equity is also called net assets or residual equity. Equity is increased by owner's investment and from revenues. So the owner may decide he's going to invest, I don't know, $1,000 in something. So that increases equity. Also, let's say that he sold something and then he had a profit of, let's say, $100. Well, that increases the equity. It also is decreased by owner's withdrawals and expenses. So if he takes money out, let's say that's how the owner gets paid, he takes out $1,000. Then the equity in the business then now is reduced by that. Okay. So equity, also called owner's equity or capital, refers to the claims of its owners. Together, liabilities and equity are the source of funds to acquire assets, because you either can issue liabilities, which are a promise to pay for something, or you can pay cash, which again is affected by the equity, in order to then be able to, which is the capital, in order to be able to use to purchase assets that the company needs. Equity has four parts, and we see that: owner's capital, owner's withdrawals, and then revenues and expenses. And then owner capital refers to the inflow of cash or other assets that the owner contributes, which increase equity. Owner withdrawal are cash outflows and other assets to the owner that reduce equity. Revenue is the increased equity from sales of products and services. So it's the revenues. It's not necessarily the profit. It's the revenue, the money that's coming in is revenues. And then expenses are decreased equity with the cost of providing the service, are the expenses. So Chaz Taylor invests $30,000 cash to start a business that's called FastFoward. So the accounts involved then, in this case, is cash, because the business is receiving $30,000 in cash. And then C. Taylor Capital, which is the equity, because he's investing equity in the business as the owner. And now, and I will, okay, and basically that's what I'm telling you. And then they give an example of that on the next page. But what I will tell you too is, in this example, what we'd have to do is we would debit cash, because we're increasing cash, and we would credit his capital, C. Taylor Capital. Because remember, everything, so the debit and the credit has to match, and our scale has to match. Okay? But that's a little bit beyond. We're going to talk about that later. So we see here how that works. So assets, cash is increasing $30,000. And we see here that C. Taylor Capital is increasing by $30,000 in the equity. Then we see here both sides the equal sign, they balance. Okay. Now let's say that a company purchases office supplies of the amount of $2,500 with cash. So the accounts involved is cash, an asset, that's going to go down. And then supplies is an asset that's going to go up. And so the example here is we would have to debit supplies for $2,500 because we're going to increase in supplies. And then we're going to debit cash by the same amount because we're paying out cash. But we see here, and that's okay. They're both assets, but guess what? Basically, they wash each other out, right? So we see then that both sides of the accounting equation are still in balance, because these two, they wash each other out. And in accounting, a negative number is denoted with the parentheses. So we see that. Okay. Let's look at another one. we purchase equipment for $26,000 in cash. Cash is an asset, it's decreasing because we're paying out cash. And equipment, which is an asset, is going to increase. Okay, so we see that in very much the same way. We see decrease in cash, so we would have to debit equipment, credit cash. It's going to basically wash each other out. We see that the accounting equation is still in balance. All right. All right, so now we see this one. So purchase supplies of $7,100 on credit. So maybe it's a credit card, or maybe it's like a Staples charge account that we have with Staples. So assets, which we have assets and we have accounts payable. We know that assets are going to increase because we're receiving supplies. And then we see that accounts payable is going to increase, liability, because we owe for the supplies. So we know that, again, it's not here, but I'm just going to tell you that we would debit supplies because we're increasing supplies. We would credit the accounts payable. And the reason for that is we see that we have to make sure it balances on both sides of the equation. So we see here that assets is increasing by $7,100, and our liability in the form of accounts payable is going to increase by $7,100. And because of that, we still have both sides of the equation are still in balance. Okay, so we see that. The other thing I wanted to tell you, just for your information, is we see that we have accounts payable and notes payable. Accounts payable usually is a shorter term type of liability that we have to pay. Notes payable will be longer term. So notes payable, usually maybe it's going to be 6 months, maybe to a year. Accounts payable would be usually maybe within 30 to 60 days, 90 days, something like that. All right. So we've looked at that. Let's look a little bit more. So to this point, we've not looked at transactions involving revenues, expenses, and withdrawals. And so now we'll go ahead and talk about that. So let's say that our business is to provide consulting services to a client, and our customer pays us and we receive $4,200 in cash right away. So we see that cash is an asset and we have revenues, which is part of equity. Both of those would increase. And so we see here, and I'll go back real quick. We see here cash is increasing, so we would debit cash because that's increasing, because we always debit to increase an asset. And then revenues, we would have to credit because we're increasing revenues, because we have to credit it because it's on the other side of the equation. So we see here that cash, $4,200, that's increasing. And we see here that revenue is increasing by $4,200. Notice that we are still in balance. Let's look at another one. This one gets a little bit trickier. We paid rent of $1,000 and we paid salaries of $700 to employees. Okay. So, and then they say here, remember that the balance of the expense accounts actually increase, but total equity decreases because expenses reduce equity. So we see here that rent expense and salaries expense, those are both parts of the equity section, and then cash is an asset. So cash would go down, and then the expenses, revenue, rent expense and salaries expense would go up. So in this case, we would debit revenue expense and salaries expense, we would credit cash. So if we look at it this way, we see that we paid $700 and $1,000, and then our expenses went up by that amount. And notice we're still in balance. And remember that expenses decrease equity. And then you provide consulting services of $1,600 and rents facilities for $300 to a customer for credit. So our accounts receivable, that's an asset that's increasing because we have a promise to pay from our customer. And a consulting revenue is going to increase, and rental revenue is going to increase. And so in this case, our accounts receivable would be a debit, and then we would credit consulting revenue and rental revenue. We'll look at it this way. So we see our accounts receivable is $1,900, and then we see our equity here is increasing for each one of those. And so again, remember that your debits have to equal your credits, and your thing still has to stay in balance. The client in transaction 8 goes ahead and pays us $1,900 for consulting services. So our cash is going to increase because he's now paid us our $1,900. Our accounts receivable asset is going to decrease because he's now paid his bill. So cash, we would debit cash, credit the receivable. And we see that basically this is a wash then. And so we see then that we're still in balance. FastFoward pays $900 as a partial payment for supplies purchased in transaction 4 we discussed earlier. So cash is decreasing and accounts payable is decreasing because we now don't owe $900. So we would have to debit accounts payable, and then we would credit cash because we're paying out cash. And so this is how that would look. So cash is decreasing, and then accounts payable is also decreasing. All right, and then we have withdrawal of cash by owner. So the owner withdraws $200 in cash for personal use. Hold on, there's a question. Let me pop up the chat here. On the last one, how do we know the $900 was cash? Okay, let me go back here. They told us that we made a partial payment for supplies. We assume that if they're making a payment, we assume that they're paying in cash. All right. So that's the thing. So we assume that they're making a payment, that they're paying in cash, unless they tell us any different. So sometimes when you buy something, you purchase things on account. And so they usually tell us if they either purchase something on account or if we're paying cash. In this case, he's saying that they're making a partial payment. So then we can assume then that it's cash. Does that help? Okay. So if they paid check, to kind of answer that question, that's a really good question. We say cash, but we really mean, more than likely, we really mean check, right? Most businesses, when they go to pay bills, they don't pay their bills in cash. Like you and I, we might go down, maybe we have to pay our cell phone bill, and we might go into, say, I don't know, the Cricket store or the AT&T store and give them cash, money. Or we might, like what we still do, what my family still does when we pay bills, is I'm still sitting down and I'm still writing out checks. And I don't do online banking, okay? Most businesses, they pay with check, but we really mean cash. So I know that gets confusing because you're thinking, okay, well, but where does the check come from? What's backing the check is the money that's in the bank account. You can't write a check if you don't have the money in the bank in order to substantiate that, in order to cover it. So we say cash, but it could be that they paid with a check. It could also be maybe that they pay with a bank debit card, maybe that's for their business bank account. So either way, but it would still be considered cash. Does that answer the question? Thinking cash, like what? I mean, these people carry a lot of cash. Most businesses don't, and most businesses don't want to deal with cash. It's a really big, that's a kind of another topic, but that's a really big issue. It goes back kind of what we discussed earlier with internal controls. That's a problem, right? And it also creates obviously a big safety issue. So a lot of businesses are not going to, deal with in cash, and they're certainly not going to pay their bills that way. Now, there's some businesses that maybe have to do that because of the regulatory environment around it. So, for example, some of your marijuana dispensaries, they're not allowed because federal law still says they're not allowed to have a bank account, and they're not allowed to bank. So for them, banking is a lot harder. So they might, if you work, let's say maybe at a marijuana dispensary, you might actually get paid in cash. You still have to report on your taxes and everything just the same as otherwise. But it's just because they're not allowed necessarily to have bank accounts and have things. And we're hoping the law changes, right, for that. Again, looking at this one, kind of got off there, but it's okay. We don't want to make sure to, if you have a question, chime in, stop me. All right. This one is owner withdrawals cash for personal use. More likely, he could have taken cash out of the cash register. He could have also written himself a check, either way. So we see here that cash is going to increase, and his equity section with the withdrawals are going to increase. So cash is going to decrease, and then the withdrawals would increase. So remember that the withdrawals account actually increases just like our expense account, but total equity decreases because withdrawals cause equity to go down. So you would have to debit the C. Taylor withdrawals account and you would credit cash. I'm kind of getting a little bit ahead of myself telling you the debit and credits because we're going to talk about that next week, but it's kind of good we're talking about it now because that's going to become important later. So you see here, cash is decreasing. His withdrawals, the account itself is increasing, but it's going to decrease on this side for the equity because he's now not worth as much because he took that money out. And then we just see here just a summary of that, just showing how everything's still in balance. That's tricky, and I would say that's going to be the part of this that students I know I've seen usually struggle with, is understanding you have to keep everything balanced. You have to keep, and that your debits have to equal your credits, and that what you do to one side, you've got to do to the other, okay? If you've mastered that, you already have an A in the class, okay? I'm just going to tell you that right now. That's going to be the biggest thing. And again, we'll discuss that some more next week, and you'll have some practice on that when you get into the McGraw-Hill Connect. You'll have some practice on that. Talking about financial statements and their purposes. So first of all, you have to journalize their transactions, and that's what we're discussing in preparation of getting to that. And that's just writing them down, figuring out, how you do it. And then you have to then create different types of financial statements. So there's 4 main types of financial statements. One being the income statement. That describes the company's revenues and expenses, and it gives us, or it computes the net income or loss over a period of time. And this could be over the quarter, this could be the month, this could be the year. And you usually use this because you want to compare the performance of the business to what happened in the prior quarter or the prior month or the prior year, okay? So you'll hear that sometimes on the news. They talk about, Nike gave their quarterly financial statements. This is one part of what they're talking about, is saying, okay, did they make money or didn't they? And in a statement of owner's equity, that explains changes in equity from owner investments and net income or loss, and from any owner's withdrawals from the period of time. And in the balance sheet, that describes the company's financial position, types and amounts of assets, liabilities, and equity at any present time. The balance sheet also is good because that ensures that we didn't make a mistake somewhere along the line in recording our transactions and that everything then has remained in balance. If we run our balance statement, we realize that something's not in balance, then we know we got to go back and we got to fix it and find out where we went wrong. And that can be tedious to go back and have to figure that out, but we have to do that. Then we have a statement of cash flows that identifies cash inflows, also called receipts. So cash receipts, cash inflows, that's when the business is receiving money. And then cash outflows are payments that are made over time. And again, those payments might be with a debit card or a check or cash money. Businesses, we'll talk about that later, I know, in one of the chapters. I'm not sure exactly when, but we'll talk about it. Businesses sometimes will keep what's called a petty cash fund that they'll use to pay cash for maybe small expenses. And so we'll talk about that. But so those are the different types of financial statements. And then we see here on this slide, we see examples of some of them. So we see in the top one here, we see an example of an income statement. And the income statement for FastForward includes revenues of $6,100 and expenses of $1,700. So they had a net income. Another way of saying that is they had a net profit of $4,400, which we see then flows down. And let me see if I can, let's see here. Can I back up? I'm trying to get a pointer. Let me see if I can get a laser pointer. See if you guys can see that. So we see here that you have, again, the revenues, $6,100, the expenses of $1,700. We subtract the two, we get a net income or a profit of $4,400. Then we see that that goes down into our net income. So this is, then the next statement is the statement of owner's equity. So we have C. Taylor Capital at the end, at December 1 of 19, he had none. Then he had investments by owner of $30,000. He had this net income of 44 that increases. So his total net income then is, or the total for his equity then is $3,400. So you add the net income from up here, down here, you get that. So his equity then is $34,400. And then he withdrew, we said $200. So then we have the equity then for him at the end of the month, well, actually the end of the year he had was $34,200. So then the total amount of his equity then goes down into the balance sheet. So we see here that he had C. Taylor Capital, $34,200. So we have the liabilities plus the owner's equity is $40,400. His cash, supplies, and equipment, total assets. We notice then that both of these are in balance. So we know then that everything's okay. Everything was recorded properly. Balance sheet again from before. And then the cash goes down here to the cash balance where they're at now. So $4,800. But we see here then, again, listing everything that they paid cash for, what they paid out. So return on assets, or ROA. So that is stated in ratio form as net income divided by the average total assets invested. So return on assets is the net income divided by the average total assets. And so where average total assets is the beginning total assets plus the ending assets divided by 2. And then you see here an example they're breaking it out, so for Nike and Under Armour. And so we see here that Nike's return shows a stable pattern and has outperformed Under Armour in each of the 3 years. We see that theirs is a lot higher than what Under Armour was for their showing and how they're doing. And I do know that there's a question or two on the homework about that. And again, return and risk analysis. So one of the things that you have to think about is when you're investing or you're considering, what to do, is think about what kind of rate of return you want to get and you're expecting to get. Usually the higher the return that you expect to get or that you want to get, the more risk that you are going to have to accept and take on. Okay, so there's many types of different returns that are reported. So an ROA, you might think about the interest return on savings accounts or the interest return on corporate bonds, which are debts that companies issue. They issue bonds in order then to pay. They have to pay back the money principal along with interest. So right now, for example, the interest return on savings accounts we know is going to be very low because of what's going on in the economy. And so you're probably lucky if you get 1% on a savings account interest on a bank account savings account you might have at a bank. And then the interest rate on corporate bonds, those might be a little bit higher. Again, it depends upon the type of company and what their history is. Now, risk is the uncertainty about the return we will earn. So the lower the risk, the lower the expected return. So we see that, for example, Treasury bonds, about 2.5%. We know that they're stable. We know that the Treasury will pay their debts. So we know that we have pretty decent certainty that they're going to pay and you're going to get your money. And in low risk corporate, about 5.8%. So we know that, again, companies that are really stable, they're making money, they're not affected by the things that are going on in the economy. They're things that people need all the time. They're doing well themselves. Medium risk corporate, again, they're not doing as well. So they're going to have to pay a lot more for their debts. And then we see high risk corporate. These are companies that, basically junk bond status. And so because of that, in order to get people to invest, they're going to have to pay a lot more interest out. So finally, we talk about the different types of activities for the business. You have investing and financing and then operating. So this illustration summarizes business activities. Planning is part of each activity and gives them meaning and focus. Investing, assets, and financing, liabilities, and equity are set opposite each other to stress their balance. Operating activities are below investing and financing activities to show that operating activities are the result of investing and financing. So in order for a company to be able to operate, we have to invest money in them. And sometimes a company can either go out and get investment money, or they have to get financing money, which would be in the case of getting debt, either loans or getting bonds. So investing is one of the three activities we talked about. So investing activities are the acquiring and disposing of resources or assets that an organization uses to acquire and sell its products or services. So for example, asset management is the determining the amount and type of assets for operations that it needs. Assets, again, is the invested amount. Liabilities are creditors' claims, and an equity is owner's claims. And then financing provides the means for organizations used to pay for resources such as land, building, and equipment to carry out plans. So for example, you might have owner financing. That's resources that are contributed by the owner, along with any income the owner leaves in the organization. And then you might have non-owner financing. Those resources contributed by creditors or lenders. So for example, my church, this happened several years ago. They built what they call a worship center, but basically it's a sanctuary. Well, we took a loan out with what was then County Bank for $3 million to build a building. So they owed $3 million, and then they received that, and they used that in order to pay the contractor and everything to be able to build this building. Another example of non-owner financing is what Merced College attempted to do on the last election. They wanted to issue bonds, which is a form of debt, financing. So the college would have issued these bonds. They would have received the cash money. And then the people that own property in the county, they have to pay through taxes, through property taxes, they have to pay principal and interest in order then to pay for whatever it was that the college was issuing bonds for. And they were issuing bonds to build new buildings, upgrade buildings, etc. And obviously that failed because it wasn't the right time, for that. But that's an example of non-owner financing. So companies can choose to issue bonds, or they can go to a bank and take out a bank loan. Different ways that happens. And then finally, our operating activities. This involves the use of resources to research, develop, purchase, produce, distribute, and market products or services. So a business, let's say Save Mart, they have to purchase the products that they sell from a wholesaler. They might have to, maybe they have a product maybe that they're going to develop and have made maybe. They have to produce products that they're going to sell, and then they have to figure out the distribution, and then they have to market them in different ways. And so strategic management then is the process of determining the right mix of operating activities for the type of organization, its plans, and its market. So that's something, usually it's the higher level managers, the CEO, the CFO, those type of people that are making the strategic decisions of a business, and they hold to that. But they're the ones that, and that is the end of chapter 1.